I want to welcome you guys to the Metro Detroit Commercial Real Estate Group. It's been too long since we got together again. I'm going to record our meeting. Those of you wanted by the FBI might want to jump off. And if you guys see me, I'm looking up over here. It's because my screen is here, but my camera's here. So when I'm looking this way, I'm actually looking at you guys, if that makes sense. The world is coming back. Business is booming. It's really been a crazy, especially the last 6 months. I want to say in the market, sales are doing well. There's not enough inventory on the market. And Devon Jackson, who's on, is the co-leader of this meetup group. Say hi, Devon.
Hello. Nice to see you all.
And I'm again, my name is Malcolm Turner. I'm with Castle Commercial Capital. We do commercial financing. And Devon Jackson is with PA Commercial. And what is it you do, Devon?
I'm a commercial real estate broker. I do transactions.
He does transactions. So he sells the real estate and I finance it. And we lead this merry band who are seeking to learn and to grow in commercial real estate. And so let's talk a little bit about the market. Any comments you want to make about the market, the multifamily market specifically, Devon, before we get going?
Well, I can say that in Detroit, a couple of factors, in Michigan, a couple of things kind of jump out. Between 2020 and 2021, which was just last year, the number of transactions in Michigan went up by 800% between 2020 and 2021 for multifamily. People talk about industrial properties being squeezed or being in low supply. Multifamily properties are in lower supply than are the industrial properties at this point in time. And you got to pay attention to the markets, the sub-markets. I mean, Midtown versus CB versus downtown versus Canton versus Traverse City are 3-4 different, entirely different markets. So if you're looking at property, look beyond just what Michigan is doing, look at what that market or sub-market is doing to understand what kind of performance you can expect once you buy a property. But that's kind of it. I mean, there's opportunity. There's off-market opportunities as well as on-market opportunities. But off-market requires a lot more work. But because you got to make sure the buyer is interested in selling and that they're willing to share information so that you can analyze the property. But there are some chances that you can get that done as well.
Awesome.
Awesome. It's a hot market.
It's a very hot market.
In fact, the cap rates went down from in the last few years, from about 8.5 to about 6.5. So I qualify that with a range because every transaction, in every transaction, we don't record the cap rate, so you can't use it as a hard number.
Well, let's get into our presentation. I got to share my screen. Okay, can everyone see my screen now?
Yes.
Awesome. Okay, so what we're going to talk about right now is different financing options. And one thing I want to stress is in this market, as tight as it is, buying opportunities still abound. And it's a matter of being really diligent about what's your method of acquiring properties. How diligent are you with following up? Some of the people that I deal with that get great deals, they've been talking and schmoozing the seller, for months, sometimes over a year. Sometimes it's being in the right place at the right time where their offer doesn't get accepted, but they keep hanging around. And then the higher offers will fall through, and they're there, and they're available. And so if the financing is important, but you got to buy right at the beginning, obviously, because overpaying and not having a good deal doesn't benefit anybody, and the financing doesn't work if the math doesn't work. Would you agree with that, Devon?
Yes, yes.
It
Yeah,
is.
you got to produce enough income to cover the mortgage and your expenses and reserves, etc.
That's right. That's right. And so we're going to get into that a little bit. Couple of things I want to talk about. One is one of the big options available in multifamily, or what are referred to as bridge loans. And bridge loans are loans that are available when a traditional type of financing doesn't work, either because speed is an issue, we have to move faster than a traditional financing will allow, or maybe the property's in a condition that it doesn't work. Maybe there's an issue with occupancy where we have really low occupancy and our property won't qualify for traditional financing. And so a bridge loan comes in where you need to bridge the situation you're in now, cure whatever the defect is in the deal, and then you can then go to low fixed rate long-term financing that's affordable. But at the moment when you got a deal, sometimes you just got to get the deal before you lose it, and that's where you'll fix whatever the defect is later, and that's where a bridge loan will come into play. And let me specifically talk about a fix and flip bridge loan. Now, a fix and flip bridge loan are bridge loans where you're using the loan to not only buy the property, but also to rehab it and fix it up. You can also use a fix and flip, quote unquote, flip bridge loan when you already own the property and you bought it either cash or you bought it with a bridge loan. And now I need to do the construction. I need to do the rehab now that I got under contract. Okay. And you can use that loan to pay off the first one, if there is one, as well as finance the rehab. Or if you own it outright, you can also use that loan to take cash out as well as finance the rehab of the project. Okay. By the way, if you guys have any questions about what I'm talking about as we go through, feel free to jump in. So let me go to some specifics, and I'm letting a couple more people in. Hey, Jason. Glad to have you. Let's talk about the basics of how a rehab and bridge loan. Now, and specifically, we're talking about multifamily today, because multifamily is different from other forms of commercial real estate, primarily being it is an awesome entry point into commercial, because everyone who's ever had a house, rented a house, understands the concept of a tenant paying you rent every single month. And from a lending perspective, multifamily financing is the easiest financing to qualify for when you're a new investor, because it's not complicated. It doesn't take a lot of expertise. You have a lease agreement, and with your tenants, and your tenants pay you every month. And if they don't pay you, you get them evicted. It's not complicated. The qualifying in those leases is not complicated, and the average person can understand it. So the underwriters of loans do not require a ton of experience to say, oh my goodness, this is a complicated market. What do you know about this market? Well, if you live somewhere, you know about this market. So it's not really complicated. And I want to start over here. Most investment commercial real estate, specifically multifamily, is fundable. You'd have to have a really, really messed up multifamily property that couldn't get any financing. There's almost someone out there who will finance a multifamily. Now, the exception to that rule, though, and I said most, not all, because if you see one of these properties, for example, in a war zone area, in a major urban area, okay, that is completely blew out. It's got trees growing inside of the building, right? This thing was built in 1935, and it's been vacant forever. Okay, there's a reason for that. Okay, those deals are really hard to finance. One, because the age of the property is such that there might be some environmental issues. And once you get in, if there's asbestos in it, it's a dead deal. You know, if there's lead paint, your costs go up exponentially on doing the rehab, and the math just doesn't make sense. You know, but if it's a property class A, B, C, D that either people are living in, or maybe they recently lived in, maybe it's only been vacant for a couple of years, that's a deal that's going to be financeable. You can find someone that'll give you funding for that. And for purposes, so we're all on the same page, multifamily is 5 units or more. And for the purpose of this discussion, when we're talking about rehab, we're going to talk about a limit of 100 units. Because when you get into deals that are over 100 units, that's a whole nother level of complexity. That's a whole nother level of financing at that point. What I want to talk about is the kind of financing that any relatively new or inexperienced investor can get into and can get going. And so you notice that the rates start at 7, and they go from 300,000 to 500,000. Deals smaller than 300,000 can get done. They're just tougher to do. They're just flat out tougher to do. Usually lenders like to see a value per unit. And so if you have a property and the value is 20,000 a unit, that gets really tough to make a case that there's real value there. So the smaller deals get tougher, but they can get done. And so I've done a deal probably like a month ago where the loan was only like 230. So you can find someone that will, again, but the deal was cash flowing. So even though it was small, it was cash flowing, and there was a lender that would get it done. There's no limit on the number of deals. And so what do we mean by that? You can have, as some of you may know who've done residential real estate, Fannie Mae, Freddie Mac has a cap where you can only have like 10 loans in your name. And then after you get above that, you have to, either sell a property or pay another one off before they give you another loan. What we're talking about today is going to be private funding. This is not funding in your name. It's going to be in an LLC. It's with private money, i.e. it's not a home loan. So there's not going to be a limit as to how many you could do. So you could have you could do a deal every month, and you'll find someone that'll continue to fund those deals, because in commercial, it's not about you, it's about the property. Does the property cash flow? Does the property hold value? Will it, based on an increase in rents, how much value add can you create in that situation? In multifamily, there's tremendous opportunity to create value on that. Does someone have a question?
Yeah, JR.
Go ahead.
Yes, I did have a question. Is that 5 million or 500,000?
That's 5 million.
Okay.
When you get over 5 million, again, that's another level. And typically you get over 5 million, they're going to want a more seasoned investor. Okay. And so, but you can do a $2 million, $3 million deal. And if it's cash flowing and you supplement what you don't know with really great property management, you can make up for that. And so I may own, say, 10 units, but the property manager that I hire to lease and manage that property, they may manage 1,000 units. And I can leverage that property management experience with my loan application. You guys with me on that?
Mm-hmm. So it's like using their expertise. If you're a newbie, it's like putting them down as a part of your team or your board and using their expertise as a property manager.
That's right. That's right.
Okay.
And so the and again, example, the deal I just mentioned a few minutes ago that was only 230. Okay, that was a brand new investor. Okay, he had, and I say brand new, he was brand new to commercial. Okay, so this was his first multifamily project, and the lender said, "Hey, Malcolm, he's got a property manager on this, right?" And I says, "Oh yeah, absolutely." He said, "Okay, great. All right, we ain't gonna have a problem then." You know, if the answer was no, they weren't going to do the loan. So, and in actuality, the other wrinkle in that deal was the guy was out of state. He actually lived on the West Coast, but was buying a property here in Michigan. You know, by the way, why do you guys think that happens a lot?
Developer confidence.
Say that again, Jason.
Cash flow on the West Coast.
Developer confidence, because it's about risk.
Mm-hmm. There's a bigger financial reason though. Think greed.
It's cheaper in Michigan.
It's cheaper. Yeah.
Mhm.
Sorry, I was asking the question based upon the bank. Why would they do the deal once the property manager was in place? Well, most folks know if you got California money, come spend it over in Michigan. Yeah.
Yeah. Money coming over from all over town or all over the country, because when you look at what you're buying, when you and now I'm talking about like price per unit, but the raw income, right? How many of you guys have seen investors who are buying single family residential houses and they live out of state and they're buying as many Detroit properties as they can get, because in Dallas or in Houston or in Miami, right, those properties would be what, 2, 3, 4 times as much money just to get the same $1,000, $1,200, you know, a month in rent. I saw someone, they were talking, it was a politician. They were asking him about, you know, affordable housing, and they were making a comment that, you know, it was some crazy number, but it was like, you know, 50% of Americans make $40,000 a year or less, right? And so there's a vast market for affordable housing that's not being well served right now. They're not building enough new, right? And when builders build new, they have a tendency to do what? They build higher upscale stuff, you know, because when you look at the cost of construction, they're like, well, you know what? For not that much more money, I can build a substantially bigger house. You know, the difference in cost between building a $200,000 house versus a $300,000 house is not $100,000, right? It's not that. It's not, and of course, marketing has a lot to do with that too. You know what I mean? I mean, look, we've seen houses where they put on the neighborhood Stonehenge estates, right? And then you get in there and you find cheap wire cabinets like in the pantry. And you're like, really, dude? I mean, if you need to pay $400,000 and you got these like Home Depot, you know, wire racks in the pantry that cost $5. You guys get that, right? So with multifamily, there's a huge absorption rate that's being accommodated right now, where as much as they build, they can fill them. You know, Devon, wasn't there a big, and Jason, you may know the answer to this question too. Isn't there a big development going on downtown? I think, what's his name? The Quicken Loans guy.
Dan Gilbert.
Dan Gilbert.
Yeah.
Isn't he funding like a big, like 800,000 unit development or something like that?
800,000? No.
No, I say 1,000, 800 or 1,000 units.
Yes.
It's like 800 to 1,000 units, something like that downtown.
Correct.
Isn't one of those going up right now?
It's right now, yeah, at the Hudson site.
Right. And he's asking crazy rent for those, aren't he? And someone I know came in from out of town and visited those, and they're like, man, and they are an investor. They're an investor. They're getting like, $1,000 a month rent, and they're seeing Dan Gilbert's place, and they're like, he's getting $2,500 for that. And they said, Malcolm, I just came back thinking I got to raise my rents. I'm going too low.
Wow.
Right.
Right.
Because he's not having a issue of capacity as far as, oh, I built too much. He's renting them as fast as they can get them out. So let me go back to this for a second. 80 to 100%. You can get up to 8. I'm talking about, again, multifamily properties. You can finance up to 80% of the purchase and 100% of the rehab. A major rehab is when the budget exceeds the purchase price. So someone, let's say, buying a property for $400,000 and their rehab budget is like $600,000. That's classified as a major rehab, but it can, and those will get financed, but you may get 75% on the purchase, not 80. So multiple uses. We can use this financing for acquisitions, for cash out, refinances. You could do it fixed to rent or fixed to flip. Okay. And there are folks that they don't plan on being, they don't have any plans on being landlords, but they see the appreciation when I buy the asset, I fix it up, I stabilize it, i.e. I get it to 85, 90% occupancy, and then I sell it. Right. And that happens on small projects. It happens on really big projects, where the developer comes in and they're looking to, double, triple their money in a 2-year, 3-year time frame, and then they're out and they're on to the next deal. Limited documentation. Limited documentation in the sense of generally lenders here are not looking at your personal tax returns. They're not looking at your debt to income ratios. We don't care what your car payments are or how much you're paying on your house. Usually there's little seasoning involved. Sometimes with banks, some of you guys that may have experience with banks, they'll say, hey, we want to see you own that for a certain amount of time before you refinance it. Or, before we give you another loan, you just got this one. And you say, well, no, listen, I only got this one because I need to get it really quick. So I can, because this guy was about to go crazy and I got him out of his problem, which was a substantial discount to me in value, right? But now I'm ready to get out that loan and do a just hold it for 6 more months, right? Well, in this kind of financing, you usually don't have those seasoning issues, but you will have a lot of documentation in the sense you'll have to provide pro forma operating statements, a pro forma rent roll. And for those of you that may not be familiar, pro forma is my projections of what this is going to look like. Okay, we'll give you the money to rehab the place and to lease it up and so forth. But we want to know, hey, what's the plan, right? When you get this thing done, what is market rents going to look like? And we're going to ask you first, right? I've had folks that have come to me and it's like, well, we'll get the appraisal, and the appraisal will figure that stuff out, right? That will be true, but you won't get the loan. Because if you haven't figured it out on your own ahead of time, right, and you can't tell us what market rents are, we aren't going to order the appraisal because we're not going to take the application. So now that's easy to do because all you have to do is call someone, for example, like Devon Jackson, right, and call a commercial real estate broker and say, hey, man, what are market rents for a 2-bedroom, right, in this area, or 3-bedroom or 1-bedroom? I'm kind of thinking $900 a month. Am I, reasonable? Is that a good assumption, or is that too high? Is that too low? And they can put you in the ballpark, right? And I'm going to say something about Devon that he'll never say about himself, right? Devon's pretty awesome when it comes to this kind of stuff. I've had Oh, see, here it goes. That modesty. He can't take it. Look at you. Can't take it, man. Take the compliment, brother. Take the compliment. Right. I've had Divine do deals for me where he's calculated the value and said, yeah, Malcolm, it's worth your time because this guy's right. This property is going to be worth X. And we get an appraisal done, and they're within like 3% of Divine's number. So you cannot underestimate the value of having good team members, to help you with these deals. And Divine is awesome. You'll want to have a construction budget, and your construction budget, by the way, can't simply be, it's going to cost me $90,000 to rehab this thing or $100,000 to rehab this thing. It has to be broken down. How much is cabinets? How much is drywall? How much is paint? And then what's your schedule? Like, what are you going to start first? Phase 1, phase 2, phase 3. Typically, you're going to do those budgets in draws. So you're going to pull out 45. Let's say your budget is, for sake of argument, $200,000, and you want to do 4 phases. So you take 50,000, you do some work. What's the next 50,000? Are those going to be common areas? Is that going to be the roof? Is that going to be the electrical? You have to have a plan for that. Now, if you got a really good contractor, that's great. Contractor's going to put your plan together, right? But he's got to get you the plan, right? Because when you come down to the money, we want to see, okay, if we give you this money, you actually have a very detailed analysis of what you're going to do, when you're going to do it, how you're going to do it. And then lastly, bank statements. Of course, bank statements will be required because we want to know that, you've got some cash for reserves and taxes and insurance while all of this is getting done. And generally, at a minimum, they're going to want to see the most recent 3 months of bank statements. And I'll tell you guys a key difference between private money and banks, right? With private money, generally private lenders are going to want to see how much do you have in the bank and is it enough to fund the transaction. Banks will see that number, but then they also want to source the funds. So they'll say, okay, there's 100,000 there. Where did it come from? Right? How long has it been there? Right? With us, we really don't care where it came from. You could have hit the lottery for 200,000. As long as there's 200,000 in there, and that's what you need, that's good enough to get the deal done, right? Over here, quicker closings. Typically, you're looking at 20 to 40 days is typical. Usually right now, the big bottleneck is appraisals. Appraisals are the bane of the existence of most investors. And typically, when that appraisal comes back, excuse me, it's going to be 10 to 15 days, and then we can close. And so now, depending on the size of your project, you may have another type of appraisal called a construction feasibility report. Okay, and this is where they're going to have another third party. Now, he's not looking at the value of the property, but he's looking at the property top to bottom, and he's looking at all the stuff you're going to do to it. And he's saying, okay, you're going to put $500,000 into this property. Does this budget make sense? Right? Because it's not like someone ever got cute and said, well, man, let me put a budget for $500,000 together, but it's really only about $300,000 worth of work. That has never happened. Right? And then folks are like, they get cute, like, oh, well, I'm going to put $10,000 a kitchen, then we look at the thing and we're like, man, this is like $2,000 in that kitchen. We can't approve this for 10,000, right? And I know I probably shouldn't have to say it, but I'm going to say it anyway. Never lie to your lender. It's a bad idea. The due diligence process is such that things come out sooner rather than later, right? Sometimes later, folks think, oh, I got away with something. And then right at the very end, You know, I talked to someone the other day, and we needed some explanation on part of their budget, and they were like, "Well, Malcolm, just make up some stuff." I'm like, no, you tell me what you're doing. I can't speak for you.
Right.
You got to speak for you.
So question, Malcolm, not that there's a guy named Trump who did this, but is that considered wire fraud?
It would be if, right, you lie and then you get the money, right, and knew that you had no intention of using it, right? I remember I had a guy once, he wanted to get a line of credit for his business, right? And he wanted to use it for real estate. And I was like, well, wait a minute. You said this line of credit is for your business. If you're going to use it for real estate, then just get a real estate loan, right? And he was like, yeah, but it's non-recourse, right? I'm like, yeah, it is non-recourse. So I can do whatever I want with it. And I'm like, okay, so you're basically telling me that you're going to say whatever you got to do to get the money, and you're going to use it for whatever you want, not for actually the intended purpose. And I was like, okay, number one, that's not going to work. And number two, never tell a lender that. It's like, I can't do business with you. I can't. I'm sorry. I wish you much success in life, dude. But he was sort of thinking, oh, this is non-recourse. It won't come back on me. So who cares what I do? It's like, no, we care. And when it comes to construction, now construction can get a little, what's the word I'm looking for? Wishy when it comes to, what are we actually doing? Because stuff happens. You get into a project, you take a wall out, and then you're like, oh my God, there's all kind of stuff behind this wall we didn't know. Or you go to put new tile down, and actually you need a new subfloor. Okay, so changes are okay. Change orders happen. Okay, and those things are allowable. That's why generally most lenders allow for a 5 to 10%, budget contingency just in case stuff happens. That's normal. But we can't say, oh yeah, we're going to borrow this money and we're going to use, 50 grand for a parking lot, and then decide, oh, we're not going to use the 50 grand for the parking lot. We're going to use it for something else. Well, no, that's not how you said you're going to put a new parking lot in there. We're counting on the value that parking lot adds. Now, if the borrower says, and I had this happen recently with someone I'm working with, where they said, hey, you know what? I decided to change my mind on that parking lot. I'm going to take it out, but then I'm going to put something else in its place that we need more that's going to also add value to the property. We're like, oh, great. And then we redid the budget, and we recrunched the numbers, we redid the draw schedule, and everybody's cool. Last thing, term length, 6 months up to 3 years. Usually 3 years is going to be a really big project. What's typical is 12 to 24 months. Most of the time, the lender's like, okay, we'll do 12 months, and then we'll give you like 12-month extensions.
Okay. Do you see Lakeisha's question, her hand?
I do not. Actually, I did not. Lakeisha, what's your question?
Going back to what you were saying, that he wanted to get a loan, but he was getting it from his business.
Mm-hmm.
So if he was getting a loan for his business, as long as it was a real estate loan, then that would have been okay. It had to be backed by the actual real estate. Is that what you're saying? Correct.
Because what in his situation, it was like a trucking business.
Yeah.
So he was borrowing money under the guise of, I'm going to use this for my trucking business. But in actuality, he was going to not give any of that money to the trucking business. He was going to turn around and buy real estate.
But what if the trucking business wanted to invest in real estate?
Well, that's a different scenario. But then I would say it's not really a trucking business, right? Because that's going to be the question is, if the trucking business, usually when we lend money to, example, a restaurant, okay, we're going to want to see that they're using for that business purpose. Okay.
Yeah.
If example, let's say he wants to buy a warehouse for his trucks, right? That's a
Yeah.
different, okay, that's a whole different scenario. You
Or
know,
anything, because a business, they like to make profits too. They want to have passive income and own other businesses and things like that. So they could actually want to invest in real estate. Like if they had money that was left over in reserves, like
right.
capital.
And what we would do, and here's the key thing. The key thing is just disclose it up front,
Yeah.
right? Because we asked them very specifically, what's the purpose of this loan? What is the use of the money?
Right.
Right. And if someone says, oh, I want to, example, I got a deal I'm working on in Tennessee. Okay. It's a 3-unit shopping center. Okay. The guy's got a Thai restaurant. He's been there like 10 years. Okay. Next to him is a AAA that's been there the same time. And then next to that is an auto repair place. Okay. They're all making money like crazy because COVID didn't affect none of those 3 businesses at all.
Yeah.
Okay. Even his Thai noodle business, because he makes the best noodles in Tennessee. And his financials were like this during the
Wow.
pandemic. Right. But the owner of the building wanted to sell it and put it on the market. And his thing was, well, wait a minute, I don't want someone new that might come in and raise my rents, or maybe they don't want to renew my lease. And now I may have to move when his lease comes due, like I think it was like another 4 or 5 years, right? He's like, I've been here for 10 years. Everybody knows me here, right? So he went to buy the building. And now what will happen is he's got a noodle business, but he's buying that strip mall, and
Yes.
he's going to pay his self rent, right?
Yes.
And then he's going to collect rent from AAA, who has another 8 years on their lease. He's going to collect
That's
rent
awesome.
from the auto repair place, which they signed a brand new lease. They got like another 7 years on theirs, right?
Wow.
So, now for me, he's transparent.
Yeah.
I'm not trying to borrow $1.7 million for my noodle business. I'm trying to buy the real estate, and I intend to make money
That's what I mean. He hit
off
the
those
jackpot too, by the way.
And I'm curious, Malcolm, did you do this as a working capital or a 504 SBA?
No, you cannot do that as a 504 SBA because it's investment property, right? It has to be owner. Now, his section is owner occupied, right? But he's only got a little piece of that real estate. He's only used, his footprint is small. So the vast majority of the real estate is these other.
And it's just
tenants.
2 different businesses too.
Right, exactly.
Yeah, and I forgot the rule is 51%, not 33 1/3. My apologies.
No. It's a great question. I'm glad you asked it, because let's flip that script. If he was using 2/3 of that space, okay, and then there was like a little State Farm office on the end, then he could do an SBA loan and use it for that purpose, as long as you're using 51%, right, of the space. In this situation, it was just an investment loan. Now, what we advised him to do is not to put this property in the same LLC as his noodle business, right? He's going to set up a brand new LLC that's just going to hold that real estate.
And question for you, you wouldn't, let's just say for hypotheticals, the building was owned in a single purpose LLC. You wouldn't say buy the existing LLC with the cash flow as opposed to starting a new one?
No.
Okay.
No. Well, is that technically possible? Yes. Okay. But generally, most of the time lenders want to see a clean LLC, and usually their attorney who's advising them wants to see a clean LLC, because if I keep the LLC, I'm also buying that person's liability, right? So, a matter of fact, my church had a dispute with a company where we gave a deposit for a church event, and then the company got sold to another company. right? And then it says, oh, well, if you're not going to do the event, we want our money back. Oh, well, it's got nothing to do with us. That's a separate company. See, and now I'm on the board, right? I wasn't born yesterday. I might have been last night, at night, but not last night, right? So I'm like, wait a minute. Those deposits got transferred. One, just like in a tenant situation, right? Those security deposits got transferred. You guys got that money. But even besides that, for a second, they're operating under the same name. It's the same DOB, right? So you can't operate as the same business and then just say, I'm a different person. And you don't have, I was like, you're going to give us our money, dude. Just trust me on this. You're going to, one way or the other, right? You're going to spend it in legal fees, or you're just going to give us our deposit back, right? So generally, that's where if you had a clean LLC, right, you those legal issues don't follow you. And usually, in a sense of real estate like this, liability usually occurs when people do stuff or don't do stuff, right? i.e., a property manager gets fresh with a tenant, right? Or someone was supposed to do something for safety reasons and they didn't do it, and now someone got hurt, right? But something just sitting there holding something, there's no performance or non-performance there. So that's why usually you have a holding company hold real estate, and then the operating company is actually doing stuff will be a separate LLC. But that's where those two won't mix. Now let's get to long-term fixed rate loans. This is where rates are going to be. Now, I did this at somewhat current rates, right? I said starting at 5.375. If you were doing a $4 million loan on a multifamily, your rate would actually be lower than that. But if you're doing 350, you're not going to see rates that low because of the size of the loan. Okay, so I kind of meshed that a little bit together. And right now, interest rates are all over the place because of what's going on in the market. Okay, most of the time you're going to be in this sweet spot of 350 to 5 million. One of the changes that has occurred in the last, I want to say 3 years, is that the minimums on loans have actually gotten lower. It used to be in the old days, if you weren't doing $2 million, nobody really wanted to talk to you, or if they did, they wanted to charge you some ridiculous interest rate through the nose. And what's happened is Wall Street money has come into the private lending area and has reduced rates substantially for smaller deals. So you can get a very competitive interest rate on a relatively modest property. Most investment multifamily is fundable. We kind of talked about that earlier. There's no limits on the number of units. You could be 5,000 units. It could be 5 units. It's going to get funded. You typically, we talked about this already, going to fund it in the LLC, not in your personal name. Again, with private money, there's no limits on the number of deals that you can get funded. It's not like, oh, you have $25 million in debt. That's not how commercial lending works. It's like, well, you've got, $35 million in real estate that's paying you NOI, that's paying that $25 million of debt with no problem. Would you like some more money? That's usually how that goes, right? The other side of it too is when you look at 75% loan to value is going to be typical when you talk about long-term low rate financing without seasoning for a cash out. So usually, especially nowadays, lenders are much more flexible. It's like as soon as you can get that asset stabilized, it used to be they wanted to see 3 years of positive cash flow before they would give you a long-term loan. Nowadays, it could be as little as 12 months, and you can still get funding. So usually that's not going to be a much of a problem. Purchase loan to values are going to be up to 80. But generally, when you're doing a cash out refi or rate and term refi, 75 is pretty much the standard. And I always tell people, even if they're purchasing, count on 25% down. If you can get 80, that's awesome. But all it takes is one little side issue to come up, and it can bump you out of that. So as an example, I had a deal, we were working on multifamily, and there was two partners. And one of the partners had a issue, let's just say, that the bank had a problem with. So the other partner made up for the deal, because if that partner was by himself, they wouldn't have done the loan. But they said, but because you got this other partner who's solid, oh, we'll still do the deal, but we're not doing 80%. Okay, we're only going to do 70 because you still got this guy on, right? So, that those kinds of things can still happen. Now, you can use that financing for buying to rent, cash out refis. Now, here's the thing: no rehab, no construction allowed. If you're getting long-term, low-rate financing, you would have had to done all that stuff already. You're not going to have like 50% occupancy because I'm rehabbing the other 50% of the units. That lender on that loan program is going to say, tell you what, when you're done with that stuff, come back and see us, and then we'll do it. Lastly, portfolios of properties can be done. So if you had multiple deals and rates dropped, you can go back and do those over again, and refund a portfolio of multifamilies if you wanted to. Full documentation is going to be required, i.e. 3 years of financials, tax returns. They want to see a stabilized rent roll. They want to see a solid net operating income. And by the way, I mentioned earlier about the property may be stabilized only for a year. If you owned it 3 years, they still want to see those other years. Even though they're not great, they still want to see them. And sometimes that's okay, because if your trend is going up, then they still may be totally okay with that.
A quick question, Malcolm. Speaking of documentation, what's the limit on appraisals? If I'm doing a new loan, do I need a new appraisal all the time?
No, not necessarily, but generally they're going to want one. If it's really recent, but generally they'll have like depending on the loan program, it'll state in the underwriting guidelines that appraisal has to be 6 months from the date that you close on the loan, not the date you apply, right? So if you apply, you got this appraisal that's 6 months old, but then it takes you 2 more months to close, that appraisal is not going to work. It's going to be too old.
Gotcha. Okay.
Okay. So, and again, it sort of just depends on the specifics, criteria of that loan program. Which, by the way, while we're on that subject, there are more, especially for multifamily, there are more loan programs than I got fingers and toes. So it's not a cookie cutter. This is how it's always done. Different lenders have different things that they'll let go versus other lenders are like, hell no. I've sent people deals that we wouldn't do, and they're like, oh yeah, Malcolm, we'll do that deal all day. And so in my firm, we're a lender and a broker. So there's certain deals that we'll finance in-house with our name on the mortgage, is what I mean by in-house, right? And there's other deals, it's like it doesn't fit our box, right? It doesn't fit our credit guidelines, and then we'll go source it to someone else, and I've had lenders tell me, like I'm working on a deal in Illinois right now where I had a couple lenders like, oh, hell no, no one's doing this deal. This is terrible. It makes no sense at all, right? And I got another lender, he's like all over it. He's like, did you guys decide to do it yet? Did you guys decide to do it yet? Did you guys decide to do it yet? Right? because they want to do that deal bad. So sometimes it's a matter of matching the right lender with the right deal. It's not always it's a bad deal. It just might be a bad deal for them. You know, sort of like dating. You know, some people like short people, some people like tall people. Doesn't mean that that short person won't find somebody. They're just wrong for the person who likes tall people. You know.
So Malcolm, can I ask you a question?
Yep.
So I'm looking at your rate there, starting at 5.375. How are you seeing that affecting pricing now? Because the rates have moved so quick in such a short amount of time. A lot of these sellers are asking cap rates that are so compressed, and everyone's kind of basing that purchase price on what they can do at a lower rate. Maybe it's a better question for Devon, since he's probably seeing it more on the buying and selling side. But how are you guys seeing that affect pricing? Yeah, with those rates jumping so high. It started at 5.375. That tells me I'm probably not going to get that 5.375. I'm probably 5.5 or above on a normal long-term fixed rate loan, which just sounds, in the short term, it sounds high, right? In the long term, it's not. But
Right. Well, look, let's be frank. We've been spoiled with rates. This isn't, you know, people getting houses with 3% interest rates, right? You know, or even commercial investment loans at 5%. That's not typical. I talked to someone in Florida the other day, and they were like, yeah, I've been thinking about should I buy now or not. I'm kind of thinking of waiting, because I talked to a lender and they said if I cash, because they were going to cash out of their house to buy a commercial property, right? And they're like, yeah, he quoted me like 4.8%. I'm thinking that's too high and I should wait. And I'm like, listen, if you got a deal, buy the deal. You know, that 4.8, right, is going to change. As a matter of fact, it has changed since when I spoke to him, right? That is not typical. You know, me and my wife, this July will be 25 years married, right? Thank God. And I met my wife 32 years ago. We were both realtors, right? And I was like young and stupid. I was like 20 years old thinking I'm going to sell real estate, right? And I did sell some real estate, because back then it's like anything else. You know, a blind squirrel finds a nut every once in a while, right? And with those rates in 1989, the mortgage on a fixed rate with good credit was like 9.75%. And you know what? We sold a ton of real estate back then.
right. But my point being, though, like when the rates are down so low, that's when prices go up, right? So now the rates are going up. What are you guys seeing are going to happen with some of the pricing on some of this commercial stuff? Because it ain't going to pencil on most of it. Now the rates have gone up so much.
Well, that's true, Robert. But here's what I'm seeing on the other side. Have you guys been seeing the rent increases?
Mm-hmm.
They've been huge. Yesterday, I saw a survey, I think it was on Bloomberg's website. The average the renters expect a 7% increase in their rents, you know, when they have to renew their leases.
So are you saying to do a deal like that, then if I'm having to anticipate rent increases, that I would have to do bridge loan financing to get the deal done? Keep my fingers crossed that as I raise those rents, that rates don't jump up on me more and I get myself in trouble because I'm doing bridge loan financing?
Well, one, if you do a bridge loan financing, that rate is going to be fixed for that term, right? So when you go to refi later, you're going to a lower fixed rate deal. Does that make sense? You're not living.
But I'm biting the bullet on that higher rate on that bridge loan financing anyway, right? Like I'm taking it in the shorts probably if I'm at 7% or more on a deal.
That's right. But if you're using the bridge loan to buy, it should be because there's something going on with the property where you can't use traditional long-term low rate finance. You know what I'm saying? Mm-hmm. So there's a example. I'm working with someone that their occupancy is 46%. Okay. So you know, they're not, they can't get a good long-term commercial loan right now, right? So we're doing a bridge, you know, and we're going to put some rehab in it. But then here's the flip side of that. Their rents right now is probably $700, $800 a month. When we get done doing the rehab, they're going to be able to get $1,250, $1,500, you know, substantially increasing their NOI. So even if rates, if they have to refi later and they say they can't get 5 or even at 6%, the cash flow is such that they're going to be fine. They're going to be really, really good.
Yeah.
You know, so, you know, understand that if you're using a bridge, it's to solve a problem. And that problem should equate to a discount relative to value. Because, you know, I know Devon has seen this too. Sometimes sellers right now, they want you to buy based on the ARV. And it's like, listen, dude, you're at 46% occupancy. I'm not going to pay you for this property as if it was full.
Right. And I guess that's the challenge, right? Like any deals that I'm seeing are just.
Robert, the biggest deals now, or deals with the most opportunities, are the value add deals, not necessarily redevelopment, but value add. I can go in, I can increase the occupancy. I can add a couple $100 a month per door by putting in an alarm or something like that. Plus, a lot of the buyers are coming out of exchanges. They're selling properties to be able to buy these properties. So they've got, so generally speaking, in some cases, they're putting more down, again, because they've got 1031 money, for example. So yeah, you're right. There are ways to look at that number and go, oh, how do we get around that? But deals been done at 3 caps. I mean, so not in Michigan so much, but in other parts of the country, they are being different. But the Malcolm mentioned a 7% increase in Michigan, in some states, in Austin, Texas, where my son is living now, 11, 12% increase in rents is not unusual.
Yeah, I guess that's where I'm struggling. It's like, man, with these rates moving so quick, it's just really affecting deals. And for me, I'm having a hard time even finding anything that's even makes sense, even on a value add. I'm not seeing anything for me personally, not that they're not out there. Obviously, you're doing one where I could take $700.
You got to dig for it. Yeah. On the flip side, he talked earlier about affordable and low income housing tax credits. Some folks are making that work, end of the market work, by using opportunity zones and tax credits as well. Those are available too, if you want to get creative on the financial side. So,
smart.
There's a will, there's a way.
That's right.
That's right. That's right. And people, it's amazing. Folks will look at rents and they'll see a sign. It'll say, we're renting at $1,200, or we're renting at $1,500, or we're renting at $2,000. If I was like, man, there's no way somebody's gonna pay that money. And then they're full. Right? And then they're full. You know, and it's like, what? You know, or you know, I saw a guy bought a property. He paid like $300,000 for it, okay, in Midtown, you know, when he was getting like $700 a month in rent. You know, he only did maybe like $150,000 in renovations, and then he started charging $1,200 a month, and he got it. You know, and here it is, 3 years later, and he's like, yeah, Malcolm, I think I'm going to try 1,800 on my next vacancy and see how that goes, and I think I might just get it, right? Because he's seeing what's happening around him. And that would be unthinkable a few years ago, you know, to see that kind of rent in that area. But folks are getting it, you know, and sometimes you just don't know until people test the market and see what's out there. The last thing I want to say is that with long-term fixed rate financing, you're going to be looking at 30-year terms, generally 30-year amortizations, and non-recourse is available. Non-recourse, by the way, is also available when you're even doing a bridge loan on multifamily. And so for those of you that may not be familiar, The difference is there's two types of commercial loans when it comes to guarantees: full recourse and non-recourse. Full recourse means I'm signing a personal guarantee if the loan goes bad and they have to sell the asset and they don't sell it enough to pay off the loan, they can come after my personal assets and everything I own in my name to make up the shortfall. If it's non-recourse, they can only go after that asset. So they better sell it at auction to cover the mortgage, because if they don't get that amount, it doesn't come off of me. Now, the exception is they have what they call, you'll see this in loan documents, standard bad boy carve-outs. And so what does that mean? Okay, yeah, it's non-recourse, but that doesn't mean you could like self-sabotage the property because you're not personally on the hook, right? So you can't, example, not pay the mortgage, take all the rents, and go to Bali, and then not, or take all the reserves that were supposed to be set aside for deferred maintenance and go to Bali or Thailand with it, right? Or turn that apartment building into like a drug den, that kind of thing. It's like, wait a minute, you managed the property in bad faith. Therefore, you violated the terms of the non-recourse provisions, and we can come in and now put a personal guarantee. So just FYI on that. So let's talk.
On
Go
your
ahead, Robert.
long-term loans, are you getting 30-year amortized on those?
Yep.
Wow, that's good to know. That helps.
Yes. Even in sometimes the loan could be shorter. So you may have like a 5-year, 7-year, 10-year loan, but it still will be a 30-year amortization, or usually a minimum of 25-year amortization. And some programs like FHA allow 35-year amortizations on multifamily. So let's talk about a case study. Now, this case study is where speed of transaction was the issue. So here's a guy had a property, the value was 500, the NOI was 53,000. He was able to buy it for 405. Okay. And the LTV on his loan was 75% of that, which is 300,000. So he did a 2-year interest-only loan. His rate was 11. Okay. All he needed to close was appraisal, title, and credit. And the deal closed in 3 weeks. Okay. So how did this happen? Well, it's the 3-week is the key thing here, because this was a situation where the seller wouldn't take his deal, went with someone else, and they walked away 3 days before closing. And as you guys know, with sellers, they've already spent the money. Like when the closing is booked, they've already in their head thought about where they're going to spend those proceeds, right? So when the buyers fell through, he sort of had his ear to the ground with a couple agents in that office, and as soon as it came through, fell through rather, he went back to the seller and said, "Hey, listen, I'll do 405 and I'll close in 3 weeks." And they were like, "Okay," because now they thought it was worth 500 in their mind, but 500 only counts if you close, right? So they sort of came down to earth. There was a little emotional. He caught him right at that moment and got him under contract for 405. And then like 2 weeks later, they were like regretting the decision. And they were like, "You're closing next week, right?" And he's like, "Oh yeah, we're gonna close next week." He's like, "We're closing next week, right, Malcolm?" Yeah, we're closing next week. And they're like, "Okay," because there's no extensions. And they sort of made that decision in an emotional moment, and then they wanted to backtrack, but he had it under contract, and we closed, and he got it. And then you see here, he refinanced 3 months later at 375, right, at 6%. So, Robert, one of the things you brought up about the bridge loans, you notice it was a 2-year term at 11. He only lived there for 3 months. And then he refied out, and obviously you see he got a little bit more cash than what his note was, right? At 300, so his net cash investment was like $35,000 and he's cash flowing 53,000 annually. Great deal. That's where opportunity comes in. And this is where he could have done, because this was a stabilized property, he could have done regular real estate, or excuse me, regular real estate financing, but he wouldn't have closed that quickly and he would have missed the window. So he would have never bought it. In other words, he would have had to do traditional financing at 500 grand. So it was in his interest to go bridge to get the discount of value and then refi again later.
Was that a single family property?
No, this is multifamily.
Was it? Okay.
Yeah, this is a small multifamily, which, by the way, I want to bring out a tool for everyone to use. On your phone, this is the Castle Commercial Finance app. So if you go to Google Play Store or the Apple App Store, if you have Android, excuse me, if you have iOS, you can download our app for free. We're going to talk about qualifying multifamily deals using the Castle Commercial app. You're going to see qualify for a loan. You're going to click on that. Then you're going to see multifamily long-term. This is for properties that are financially performing and that are move-in ready. And we're going to decide, okay, is this an acquisition? Is it a cash out, refi, or rate and term? We're going to input the number of units, our zip code, what our present occupancy, of course, is it move-in ready, which it must be, our FICO. And then other key factors are going to be what's the as-is value and the purchase price. Because we're keeping it, we want to enter the revenue and the expenses. And in this case, you see the loan qualifies. We see the maximum loan amount, our down payment, as well as our net cash flow. Now let's look at a multifamily bridge loan. So we're going to go back and we're going to scroll down to multifamily bridge loans. And this is going to be for properties that are not financially performing, or quick close is more important than anything else. And so here we're going to decide, is it an acquisition or is it a refi, rate and term, or cash out? We're going to put in, again, the number of units, credit score, what our as-is value and purchase price. And it's going to tell us if it qualifies, as well as what the maximum loan to value is going to be. If it doesn't, it'll tell you why. Maybe the price per unit is too small, like 20,000. Maybe it'll be because our property's too rural. Maybe it's credit because someone has, let's say, a 610. And then it'll tell you, hey, you need to get a credit partner. Which, while we're talking about that, what's a good credit rating to buy multifamily and commercial in general? What's a good minimum number that you need? Anyone care to guess?
620, I hope.
A little bit higher.
I would say 640.
640. Anyone else?
700.
JR. 700. 700. Right? And let me tell you why. Can you do it with less? Yes. You can do it with 640, 660, even 620. But there's got to be compensating factors. So it's got to be a deal like this deal. There's got to be a ton of equity in that thing. It's got to cash flow like crazy. Okay. And it's going to definitely have to be a bridge loan. There's no ifs, ands, or buts about that. It cannot be long-term financing. If you're doing long-term fixed rate financing, you really want to have a 680 minimum. And what happens is at 700, if you're below 700, they'll still do the deal. But then what happens, they start adding on to the risk. So they'll say, oh, because you're below 7, we won't do 80% loan to value, we'll only do 75. Or because you're below 700, instead of a, let's say, 5% interest rate, we're going to charge you 5.5. And when you get generally below 660, you're out of the, where actually I want to say below 780, you're going to be typically out of the long-term low rate financing options. You still might find a bridge lender. But even then, if you're sitting like at a 620, a bridge lender is going to want to see a partner. They're going to ask you, do you have a partner? Now, realistically, it's not impossible, but it's hard to find a deal that's so great that with something below a 640, they'll still want to do it. You know, and I want to move on to our next case study. Now here, this person, they bought a property, the ARV was 405. I'm sorry, I did ARV, that should be as is, my mistake. The purchase price was 350. They got a loan for 263, which is 75% of the 350. The refi based on the ARV comes out to 750. So they had an ARV value of 750. So based on the refi of 750, a lender will generally go 70 to 75% of your ARV. So they had so if everyone goes on their handy dandy calculator here, and someone does the math on that, and you said, okay, if my value is 750 times 0.75, that means I can have up to $562,000, 62,500 of a loan. Well, their purchase loan was 263. That means they could have a rehab budget of up to another $300,000. They only needed 200. So they did a bridge loan because they had an issue with the property condition and some other qualifying factors where they couldn't do long-term financing out the gate. So they did a purchase bridge loan that had no refi component, or no, rather, rehab component at all, because it just worked out that also because of location, sometimes the lender that you buy with is not the lender that you can rehab with. Doesn't always happen that way, but in this particular situation, it worked out where the same lender that would do the refi would not do the purchase. And the lender that would do the purchase wouldn't do the refi. So they bought at 263 with one lender, they refied with another lender, took out 200,000 as a rehab budget, but notice the NOI. The NOI as it stood was sitting at 57,000 a year. After the rehab, they're going to get $1,250 a month. That's going to put them at 90,000. And you're looking at a loan balance again of 563. So they got really good cash flow and a really good return on their investment, even though they had to jump through some extra hoops because of their situation. Great. I'm going to go to the last one. Devon might recognize parts of this deal because he worked with me a little bit on this one. This is one where they bought the property, and believe it or not, their purchase price was $300,000. It's the as-is value right now is 1.6. Now, when they bought it for 300, it wasn't worth 1.6, right? In actuality, at the time they bought it, it was probably worth 700,000. But because of seller motivation, and you guys have, if you read some books on real estate, they always talk about finding motivated sellers, right? This seller was an out-of-state seller that bought it, had a horrible management team running it. They were running it into the ground, probably stealing from them. Okay, they never made money on the deal. And they sold it at a loss just to get out of it. They were that desperate. This person put 300 cash of their own money into it. They put another 300 to rehab it. Only got the property up to like 50% occupancy. And when we did our appraisal, our as-is value was at 1.6 based on that NOI. And you'll find this interesting, Robert, of the 90,000, right? We're going to refi them out of right now for 810. They're going to take 610 and put it into more renovations. And then they're going to do the other 50% in the common areas and upgrade the property. They're going to cash out for 200,000. Okay, so they're going to have about a third of their investment back. right? Because you guys see they got 600,000 into it. When they're done, their NOI is going to be 290. And then they're going to refi based on their ARV, and they're going to pull out 1.7, which will only be 70% because the ARV is going to be 2.5 million at that point. So they're going to leave 750 in as equity. They have recouped at that point all of their cash investment in the property, and they'll buy another one with those proceeds. And then you see the NOI after the refi is going to be 150. And this
That's the cash on cash, Malcolm.
I'm sorry.
It's cash on cash.
Yeah, I was going to say that NOI is going to be I say NOI after refi. Actually, the NOI is this is going to be the net cash flow after they make the mortgage payment. It's still going to be 150 a year. Any questions about this deal at all?
Can you find me one?
This is
I was going to ask the same thing.
26 units. 26 units. So when you look at that ARV, it's just under 100,000 a unit is what the value is going to be when they're done.
What city is that or area?
That is in the lovely city of Detroit, Michigan.
It's 26 units.
Yep.
What area in Detroit?
I don't want to get too specific.
Okay, no worries.
But I will say it is, let me tell you where it's not. It's not in downtown Detroit. It's not in Midtown. It's, it's not war zone. Okay. But it's relatively, it's a stable area. It's close to a really nice area, but it's not actually in one of those super hot areas of town, because they still are going to max out at 1,250. Like they're not going to get $2,000 a rent in that neighborhood, like as if it was, say, Midtown or near the hospital or something like that.
Okay.
But obviously they don't need to, right? For the numbers to work.
Yeah, I mean, I look at it, if you're getting 1,250, I mean, that's, and you're getting that in the city, that's fantastic. And that's why I'm curious as to where, because I looked at it, so the NOI at 290,000 on a 26 unit building. So I was like, wow, that's, they're getting over $1,000 a month per unit. So I was just curious about where they getting that at, if it's not downtown or obviously or midtown, but other areas is spitting that out. So that's fantastic.
Right. Well, and then let's talk about interest rates for a second, right? What's their interest rate on the bridge loan where they're getting and obviously you see the majority of it is rehab, right? That's 9.5, actually a little bit less than 9.375%. And the rate I calculated over here on the back end, I figure it's probably going to get it at 5. So it's and this is their first multifamily, believe it or not.
That's impressive. That's their first deal. And they're putting that much in the rehab. That's
Yeah.
impressive.
And they sort of went all in. They found a great deal. They beat up the seller to negotiate the best deal possible, right? And by the way, how that part of that story, right? And I wanted to share you guys best practices, right? Part of that story was they knew when they wrote the contract they didn't want to buy it at that price, but they just bought it at that price to take it off the market. And then they constantly were beating up the seller. You know, they did an inspection and they said, oh man, this inspection is terrible. You guys got to take another 100 grand off. You know, the city said there's blight, blah, blah, blah. You guys got to take another blah, 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 blah off. Right. And then they used the speed and said, listen, if I close this deal in 3 weeks, kind of like the first guy, you know, and understand, unlike him, they already had it under contract. But they said, instead of, because I think they built into the original contract like a 90-day time frame to close. And they were like, if I close in 3 weeks, would you drop that thing to 300? Right? Now, how many people would expect them to take that deal? I wouldn't. But you know what? Sometimes, as the good book says, you have not because you ask not, right? And so they were bold enough to say, I'm going to throw this crazy offer out there and say, yeah, I'll do it for 300,000 and I'll close in 3 weeks. But I'm going to close that fast, you know, I need you guys to drop that price. And they were like, yeah, okay. And they did it. And they you know, they did it. And then what this person ended up doing, they ended up cashing out of retirement money to fund the rest. You know, now it's, you know, at those numbers, you know, is a bridge loan, you know, is it more expensive than going to the bank? Absolutely. Absolutely. But you know what this person didn't want to do? They didn't want to give up years of tax returns. They didn't want to give birth to an accountant and go through the meat grinder, you know, of that system. They were like, I need to know I can get my money. And we were like, yeah, as long as the construction feasibility makes sense, and it did, as long as we do the appraisal, the values come out the way they're supposed to, it makes sense. Yep. And I know Devon had worked up the as is and ARV numbers for me before the clients spent and committed to doing the loan, and his numbers were really, really close. Really close. Thank you, Devon. You did a fantastic job. you know, and I'm not saying I thank you for doing it. I thank you for being accurate, for being right.
Everybody gets lucky every now and then, so it's okay.
See, that's self-deprecating humor of yours. Awesome. But that's where the one thing about multifamily is once you get into that market, the volume of the numbers have a life of their own. It's like a snowball going downhill, right? It's one thing when it's the size of your knee. It's a whole nother thing when it's as big as you, right? That thing's plowing through stuff, right? And once this, like same way with this property, you know, she's getting a double bonus by doing this rehab. Not only is she increasing her occupancy to full stabilization, but because of the way she's doing the rehab, she's also increasing her rent per unit. Right? So her gross occupancy is going up, and her bang for the buck, right, is going up. What she's getting in rent per unit is going up substantially. And all she's getting is market rents. She's not like, you know, like I said, she's not getting $2,000 a month in rent. You know, she's getting $1,200, and where she's at, if she renovates it at the top of the market, you know, the appraisal backed up those numbers. It wasn't like her own thinking. You know, I know when she was in her mind, she was thinking, okay, I could get 1,250, but when the appraisal came back and it said, hey, 1,250 equates to 2.5, she was like, woo woo, oh yeah, this is awesome. I love this business, right? And why wouldn't you?
Yeah, for sure. It's a great deal.
I want to go back to our app because if you find a deal and you're wondering if it makes sense, in this situation, you would go to the multifamily fix and flip rehab calculator. And again, you put in a transaction type, you put in how many units, you also put in your experience that you may have, the credit score, the as is value, the payoff if there is one, the rehab budget, and the ARV, and it will tell you if the loan qualifies. All without having to go through the trouble of filling out a application. Does anyone have any questions I can answer at this moment? Someone asked, what are the typical closing costs like points? Great question. Great question. The real answer is it depends. Different loan programs have different pricing structures. It is by no means a one size fits all. You can find a bridge lender that will do a deal and they'll charge you 4 points. You'll find another bridge lender that'll do the same deal. They'll charge you 9. And you'll find someone else that'll do it for 3. Typically on a bridge loan, you're going to be in that 3 points to 4 point range for most bridge loans. Most bridge loans are considered higher risk than a typical long-term low rate loan. When you're dealing with fixed long-term financing, your points are probably going to be anywhere from 1.5 to 3, depending on the level of risk that the lender perceives. You know, the other thing with points is depending on your rate, some lenders give you the option to buy down the rate. So if the rate is high, they'll say, okay, listen, if you pay like 1 point as a fee, you'll buy that rate down by 1/4 point. You know, that kind of thing. So in the long run, it saves you a lot of money to buy your rate down if you can do it, if you can negotiate that. And like like with regular real estate, a lot of that stuff's negotiable. Where it doesn't become to be as much negotiable as you may like it is if there's a lot of risk. So if your occupancy, for example, her occupancy was like 50%, okay, she can't negotiate points when you're at 50% occupancy. It's like, will you do the loan? Is more the concern, and I'll have to make it up later. You have to think of that as a cost of doing business. The first guy I mentioned, he's buying it at 405. The property's worth 500. He closed on a bridge loan just to refi out 3 months later. You know, that's an expensive proposition, right? And let's say it cost him 5% total closing cost to do all of that. That's what's 5 on 40?
20.
$20,000. Okay. He got a $105,000 discount. So the math worked where he made that decision. So that's sometimes we have to be careful, you know, as we say, not to step over dollars to pick up pennies. You know, now don't get me wrong. I'm not saying fees and points and rates and stuff like that are not important. They absolutely are. But we have to think about the bigger context of the deal, right? If you can get cheaper, get cheaper. No doubt about it. I've walked away from deals. I had someone, I'm speaking at the RIA in Oakland County in a couple of days. And one of the investors there approached me with a portfolio deal. And he said, hey, this is the rate I got. What can you do? And I was like, wow, at that price with those points, take it, dude. If you honestly believe they could close, that's a steal. You need to go do it right now. You know, but again, you got to know they can close. And so, because I get deals all the time where they didn't close. And I had a deal that were referred to me. They were like, well, I don't know if this guy's going to be cheaper than the bank because he's just, Malcolm Turner. this big old bank, they're going to have a better deal. 10 days before closing, the bank walked away. And here was the reason they gave. They were like, well, it's a quad, and we don't like to do quads. Now, at what point do you think they knew that was the case? When they first took the application, it said quad, but they walked away from the deal 10 days before closing, and then they come back to me and we closed. So were they cheaper? They're cheaper in quoting them, but they didn't close, so it didn't count. So that's where that kind of stuff, you got to sort of gauge that. So any other questions before we close out the meeting?
I had a question, Malcolm.
Yep, is that JR?
Yes, JR,
Yes.
sorry. So
Yep.
if you're just starting out, would you
Mhm.
recommend finding property in an opportunity zone?
If you can find it,
Okay.
yeah. If you get, because here's my thing, a good deal is a good deal, right? So if you're willing to go out there and look and educate yourself on the market, I wouldn't, be realistic about your expectations about whether you're going to find like the perfect deal day one. I mean, it's possible, right? But it might take a while. And then like with some of these examples I gave, some of those buyers, they've been working on those sellers for weeks.
Mm-hmm.
They're like, okay, they were like off-market deals. And they're like, are you going to sell? Do you want to sell? Do you want to sell? And they finally caught them at the right time. Or they lost the deal. Someone else got it, but couldn't close.
Right.
And as soon as that deal fell through, they were right there. And they kept themselves available, because part of quote unquote luck is you got to be available.
Mm-hmm.
You got to be paying attention, right? And if you're out there in the market and you're paying attention to what things are selling for, pay attention for prices, what things are being listed for, what are the rents. I think Grant Cardone talked about, he examined the market for multifamily every single weekend for a year before he bought his first property.
Okay.
And by then he knew exactly how much he should be paying, what's a good deal, what's a bad deal. He had seen properties close and then come back on the market and then close again. And when he got comfortable, he pulled the trigger. I think he said his first deal was like a 32 unit or 26 unit, something like that. And then 30 days later, he went and bought another one. And then 30 days after that, he went and bought another one. That was like at that, I think his third one was like 90 units at that point.
Wow.
And people were like, dude, you're crazy. You're nuts. Just go get some houses. Do like everybody else. Just do some houses. You know how many houses he had before he got his first multifamily? One. One house. Two tenants were sharing rent, two women. They got into a fight. They couldn't live together no more. They moved out. And he said, I went from 100% occupancy to 100% vacancy. Right? And he's like, man, this sucks. With 26 units or 10 units of 1-2 people move, I still got cash flow. I'm still making my mortgage payment. I'm still paying my taxes. And the big thing is, if I have a $75 or $100 rent increase across the board, well, that adds a tremendous amount of value to the property versus just one tenant. And then you pull out equity and you buy you another one. And then when your rents go up again, as they always do, you pull out some more equity and you buy another.
Okay, thank you.
You are so welcome. Anyone else have any other questions before we close out? By the way, when you look up our app on the App Store or the Google Play Store, do it under our name, Castle Commercial Capital. You'll find our blue and gold logo, and you'll be able to download that app for free. You do have to register for security reasons, because there'll be a lockout to get in, so no one else can get in there if you got information saved. But it's awesome. I appreciate your feedback on that as well. Well, listen, guys, I want to thank you for participating in this meeting. I hope you got some good stuff out of it. And if you guys have any questions at all, feel free to drop me an email. You can find us on Facebook. And you can, I'll pick up the phone and give me a call. I answer. We have a YouTube channel. You can go to our YouTube channel and watch some videos on how to get approved for a commercial loan. We recorded this meeting and we're going to save it on our website. I appreciate you guys coming out. Look out for our next meetup. Will be next month. And take care and happy hunting. Have a great day, everybody.
I appreciate all the good information, Malcolm. This is Rob. Thank you so much.
Thanks, Rob.
Thank you.
Bye. Thank you.
Bye-bye.